So if you've been a homeowner for at least a couple of years, you've been paying your mortgage every month religiously, and you've been paying down your principal balance as part of your mortgage payment. The longer you've been paying on your loan, the more equity you will have built up by amortizing down your loan principal. So with that said, if you've been paying for a long period of time, you may be a good candidate to do what's called a term extension refinance, where you're actually stretch back out the term of your loan. Why would you want to do that? Why might it make sense? And is it a good option for you? I'm going to go over all the details with you in today's training. Hey, it's Robert Weinberg, and on this channel we empower people to take control of their future through expert mortgage and financial strategies. If you're new to the channel, please go ahead and hit the subscribe button. Also click the bell so you get notified on all of our future content. So in this lesson, we're going to talk about refinancing your mortgage to extend your mortgage term. And you may be thinking, what the heck is this all about? This makes no sense. Why would anyone refinance to extend their mortgage term? Seems like every financial guru and personality all over the internet and radio and TV is always talking about paying off your mortgage, getting rid of your mortgage. And what we're talking about here is the exact opposite. It's actually extending out your mortgage. But in many circumstances, this actually makes sense as part of an overall financial plan and overall financial strategy. So typically for this to work, you will have had to own your home for at least 2 to 5 years. Most of the clients that I do this with have owned their home for at least 10 years or more in order to really maximize the benefit on this. The reason is because every time you make a mortgage payment, you're going to be paying it down little by little, and mortgage interest is front loaded, which means you pay more of it in the beginning than the end. So the longer you've had your mortgage, the more you've amortized that loan down, and the more principal you will have paid, which makes this a more attractive option. So you will have either taken a 30-year mortgage out, which is the most common loan in the United States, and you'll have paid it down over the years little by little. Maybe you threw an extra 100 here, 100 there. Maybe you put a big chunk on at some points over the term of the loan. Or you might be someone that wanted to get aggressive. Maybe you took a 20-year mortgage, a 15-year mortgage, or even a 10-year mortgage, and you wanted to pay your house off aggressively at one point, but circumstances may have changed, which is why you'll want to extend it. So the most common reasons that someone would do this, and I'm dealing with a few clients right now in this predicament, are a change in jobs. So maybe you were working one place and you were getting paid a certain way. Now you're working somewhere else, you're getting paid differently, whether that be on a different schedule. Maybe your income's changed, your cash flow's changed. Maybe your family circumstance has changed. Maybe you went from a dual income household to a single income household. Maybe you took on some other debts or had something else come up that changed the way that your monthly budget works. Also, going from a working person to a retirement or a fixed income can also be a huge reason to refinance and do something like this, as we've talked about in other lessons. So the other cool part of doing a term extension mortgage is if you're in need of extra cash flow and if your budget is tight, then a lot of the time you can actually add cash out. You can actually pay off debt, do home improvements, or just take a lump sum of cash out of the equity of your home without actually increasing your mortgage payment by 1 penny. I have one very particular situation I want to explain to you, which is a client right now. He had a 20-year mortgage and he's 5 years into it. So he's got a 15-year payoff time right now on his loan. He went from a job where he's making $120,000 a year, where he went to a different company. He's doing the same job, but he's only making $100,000 a year. So he had a big reduction in his monthly cash flow. So now what he's trying to do is go from this 15-year loan that he's got left and go to a 30-year mortgage and make up the difference in cash. So what we're actually doing is we're taking him from that 15-year loan back to a 30-year term, and we're giving him $25,000 in cash at closing. Yet, check this out, his mortgage payment is going from $2,500 a month right now down to $2,150. And that even includes taking the additional $25,000 in cash. So now he's got a lower mortgage payment and he's got the money in the bank to make up for that difference in cash flow. And he's got several kids and college coming up. So this was a strategic financial move for him to do. And this is the type of thing that's possible with one of these term extension type of mortgage refinances. So it's really important, as we're saying, to do this as part of an overall financial strategy. If your budget is tight, if you've got debt, these other reasons we talked about, that's a good reason to do it. But don't just do it for the hell of it, because at the end of the day, it's very important you understand you are going to pay more interest by extending your mortgage term. You are going to have the mortgage for a longer period of time, so there are implications to doing that. But it's much better off that you do this type of mortgage term extension refinance rather than getting into credit card debt and having to use credit cards to make ends meet, rather than taking out a personal loan to make up for a budget shortfall, or any of those other horrible instruments that are out there that allow you to dig deeper and deeper into debt. Using the mortgage as part of this financial plan can really be the best or a necessary evil, so to speak, versus some of the other options you may have to take out loans. So the other thing to keep in mind is that depending on interest rates, when you took out your original loan versus where they're at now, it may or may not reduce the mortgage interest rate. So if you've got a 3% mortgage on 15 years, you may actually be going to a 30-year mortgage at 5% or 4.5%. So your interest rate may actually be going up, but your payment's going down. So normally with these term extensions, you really can't be picky about your interest rate. Of course you want to get the best deal and you want to get the lowest rate possible, but you need to look at what you're actually accomplishing. And normally speaking, on a term extension type of loan and refinance strategy, you're not going to be reducing your interest rate. So although on a normal refinance, that is a motivation, with this type of strategy, it is normally not a motivation. So don't get too wrapped up in that, and understand how that plays in with the overall scenario and what you're trying to accomplish. So I hope that this has been of value to you. I hope you'll share it with others who may benefit, and I hope you'll reach out by call, text, or private message if I can be of assistance to you or anyone that you know. Thanks for watching, and we'll talk to you soon.